We're going to go ahead and get started. I'm Doug Anmuth, JP Morgan's Internet Analyst. We're pleased to have with us today Jose Neves, founder and CEO of Farfetch. So Farfetch is the leading global platform for the luxury fashion industry and is driving luxury e-commerce penetration. The Farfetch marketplace connects more than 1,400 luxury sellers with almost 4 million active consumers across 190 countries. Farfetch also has a first-party business and has built out e-commerce enablement through platform solutions. Last year, the company did more than $4 billion of GMV through the platform. And looking forward, targeting $10 billion of GMV and low double-digit adjusted EBITDA margins by 2025. So Jose founded the business in 2008, really stemming from his background across both fashion and technology. So welcome, Jose.
Thank you, Doug. Thank you for having me.
All right, so let's see, 2022 was a challenging year in lots of respects, just in general. But, you know, for you guys, Russia, China lockdowns, FX pressures, heavy promotional environment. You just reported 1Q earnings last week. How are you feeling about the business in 23?
We're feeling very confident. I think maybe taking a step back and looking at the bigger picture, I think luxury has proven to be an extremely resilient industry. In the last 3 years, so between 2019 and 2022, the industry grew 8% on a CAGR basis, which I think is very impressive, given that 80% of luxury sales still happen in physical stores, and the stores were open and closed, throughout the world. Clocking that 8% growth was another proof that this industry is a very resilient industry. In the same period of time, Farfetch grew 24% on a CAGR basis. So whilst 2022 was a challenging year, Russia was our third largest market. We decided to stop trade in Russia after the invasion of Ukraine. China is our second largest market, and due to the very austere lockdown measures, that country went into double-digit negative growth. And in spite of all of that, we over the 3 years period, we acquired market share consistently, and in fact, the underlying business outside of these macro factors remains very strong. So in Q1, we grew orders by 18%, excluding Russia and China, and we accelerated in every single market. China is now back into positive growth quarter to date, and the US, we saw an acceleration, although still in negative territory year on year, but positive net new customers around 9%, 7% increase in orders in the US market. So we see that the underlying business continues to demonstrate a lot of strength. And as we comp over Russia and China FX, which was a very significant headwind for us, we're very confident that bodes well for our plans for the rest of 2023.
Okay, great. Maybe just thinking about the US business, a number of luxury players have called out some of the weaker trends in the US, and also, of course, you've also talked about a heavier promotional environment, a little bit more weakness among aspirational customers. I guess what gives you the confidence in the US business kind of stabilizing and growing more in the back half?
Look, I think first of all, we have a very small market share in the US. US luxury industry is, depending, some analysts points to 120 billion. Let's use that number. So we're give or take 1% of market share. Online, it would be 5% of market share. So it's a very small market share. Farfetch is, and I think this is important to understand the competitive dynamics and potential of the business. We're the only platform business catering for this $360 billion industry. What I mean with that is that everyone else is a retailer, either a boutique that become an e-tailer or a department store. Amazon has tried to enter the luxury space a few times. Amazon luxury stores was, I think, 2-3 years ago was the last attempt. They haven't really been successful at entering this space. And so Farfetch stands alone as the only marketplace model and true platform model, catering for what is a very resilient, attractive, very large industry. So the fundamentals in terms of us being able to capture market share in the US and grow our US business in the medium and long term, I think are very solid. I think you talk about the aspirational customer, and we'll get there, but I think we also have the private client customer. This is the VIP customer. It's the largest VIP business in the world. We do over $1 billion with 1% of our customers, which account for 27% of our sales. These are around 35,000 customers in total. This is globally. In the US, it's a fraction of that. Now we know that department stores typically have 100,000 VIP customers if you use exactly the same metrics to classify them. So we're only scratching the surface. We could grow our private client base in the US, tenfold. And we believe that segment is very resilient. We continue to see average order value is very stable at $1,100 for our private client. We continue to see the average spend per customer around $40,000. We continue to see a very high retention rate, 90% retention rate on that top tier of customers. Now, the more aspirational customer, obviously we're going to continue to stay vigilant in terms of how the macro evolves in the US, and we knew that beginning this year already, that we've been saying since Q3 that the market is becoming promotional. We saw inventory build up in all the luxury retailers, which we knew this always leads to promotional activity, and that obviously attracts the aspirational customer and much more than the rest of the business. So in terms of the aspirational customer, I think we still see net new additions of customers. In fact, Farfetch is one of the very few e-commerce businesses that went through COVID, 2020, 2021, 2022, and Q1 2023, and never in a single quarter we lost active customers, including losing Russia, which was 350,000 customers. We have 4 million customers in total, so 350,000 is a significant number. And even with that loss, we consistently added net new customers, and in the US we continue to add customers in spite of pulling back on advertising in the US to the tune of 20% this last quarter because of the promotional activity. We want to focus on profitability this year, but we're still adding customers. So that to me demonstrates that there is demand. The aspirational customer is shopping. They're trading down. They're shopping. They're taking opportunity to benefit from the promotions that are out there, but they are around, and this is a very resilient category. So as we see the rest of the year continue, I think in Q3, Q4 we will comp over our decision to pull back 20% in terms of advertising expenditure in the US as a percentage of revenue. So that will comp in Q3, Q4, and as we continue to see this organic growth in terms of number of customers, also the dynamics in terms of our own clearing through our own 1P inventory will improve towards Q3, Q4. So all in all, we took a very balanced view in the beginning of the year when we set our plans, and there's no reason. I mean, we continue to be very confident with that view, including the US.
Okay, great. Let's shift gears a little bit. Talk about China. You talked about a return to growth quarter to date. It still kind of feels like recovery in China is a bit slow or choppy, and I just mean broader kind of overall recovery there. But maybe you can talk about how the business is trending on a multi-year basis, how you're thinking about timing to more complete recovery.
I think, first of all, China is going to be potentially the largest luxury goods market in the world. So most luxury analysts, they point to that outcome in a few years' time, certainly by 2030. It has been the engine of growth for the industry, and actually currently now in Q1 and Q2, it has been the engine of growth as things start to come back to normal in that country. A few things that are very exciting for us. So first of all, online penetration of luxury in China is very low. It's around 10%. In the US, it's above 20%. And this is very interesting because China typically has higher online penetration. So if we look at online penetration of e-commerce, is 50% generally in China. So it's even higher than in the US. So this is a category that, because of the barriers to entry, the difficulty that brands have, the luxury brands have reaching the customer, Chinese customer digitally, and the fact that there's very high barriers to entry for Western players in that industry. There's this restriction in terms of supply, which is very good news, because as we bring more supply into that market, we think we're in a very good position to capture that. I mean, the last thing that excites us a lot is that we're really the only company, the only Western company that is succeeding in China in our space. Even in e-commerce, there are not many companies that have been successful in that market. We've been investing for 8 years now, so we have a fantastic team on the ground, incredibly localized app services, private client services, local marketing presence in the various platforms. We have a partnership with Tmall. We have our own storefront on the Tmall Luxury Pavilion app. So the two largest online luxury platforms in China are Tmall as a domestic player and Farfetch as a Western player. And this is a very good position to be in, and I think that makes us even more strategic for our brands, the brands that sell and the retailers that use our platform to reach global fashion customers. And I think this bodes really well in terms of the expansion of that opportunity in China in years to come. I think this year, the good news is we're back to growth. I think, it will take time. It won't be, this year we're not forecasting a return to the 2021 levels of business there. 2022, we were double-digit negative in that market. I think this year we will recover part of that territory, but we're not needing to go into the 2021 levels to deliver on what are our expectations for this year. So we're very confident. I was in China just 10 days ago, spent a week there. It's clear that there's strong appetite for luxury in that market. Things are back to normal. No one's wearing masks. Everyone is, I went to Plaza 66, which is a local shopping mall, the top shopping mall for luxury brands, and there were people queuing out of the Louis Vuitton store, and that store has 40,000 square feet over 3 levels, so not bad. And the same thing with Gucci, the same thing with Saint Laurent. I saw a lot of appetite for luxury, so it's definitely coming back. Of course, you see the luxury brands, the comps are completely all over the show, because this time last year, they were all closed, those stores, right? So of course, you're going to see like this, plus 40, plus 60, whereas Farfetch, we continued, although it went down, but we continued obviously to service the customer to some extent. So yeah, we're very bullish in terms of China in the medium long term, and the projections for this year, we think we're delivering to plan, or maybe a little bit slightly ahead of plan.
Okay, great. So we think about the business. Marketplace was initially built around boutiques. Over the last several years, your relationships with brands, of course, have grown very strong. Maybe you can talk about that a little bit. Maybe give us a sense of kind of mix of either inventory or GMV that you're seeing on the platform between brands and boutiques, and how you think that trend's going forward.
Supply is growing very fast. So the supply from our top 20 brands grew 60% in Q1 year on year, which is staggering growth. Retention of sellers is typically in our business almost close to 100%. So we have consistently retained both the boutiques and the brands that have joined the platform. We're a very curated marketplace. So you don't have a page like add your boutique to Farfetch or add your brand to Farfetch. We will find you and we'll choose you and approach you. And this curation of the marketplace means that the brands trust us and the consumers trust us. So what we've been seeing is a gradual but consistent deepening of the relationships we have with both the brands and boutiques. Right now we have 800 luxury retailers using the platform. Some are very, very large. Some are department stores, multi-billion department stores. Others are just, the best, local neighborhood boutiques, luxury boutiques. I know we have some in Boston. I forgot the name now. I should have prepared it. But it's really la crème of luxury retail. That's in terms of the retailers. And then in terms of the brands, we have 600 brands directly on the platform, from the Gucci's, Prada's, Burberry's, Saint Laurent's, 600 of them. So Brunello Cucinelli's, et cetera, et cetera. And this is a relationship we built over 15 years. So we see that relationship deepening. I think to your question, the brands are becoming a much larger part of our business, as you would expect. That 60% growth in inventory that I mentioned is mostly, vast majority coming from brands, not boutiques. And right now it's more than 50% of the supply that we have available to sell on Farfetch is coming directly from the brands.
Okay, great. Let's talk about platform business, which is really evolving very quickly. I guess if you think about how you're building out platform relationships, Reebok is a big one this year. So maybe you can just talk about how you're working with Reebok in Europe, kind of multiple ways, and also a little bit about how this gets recognized through the P&L.
The brand platform business in particular, or the Farfetch platform solution?
Sorry, let's talk Reebok, the Reebok Europe relationship overall.
Yeah, sure. I think we identified 4 years ago. We identified that certain brands and certain creators and collaborations were driving a disproportionate amount of hype and buzz and cultural relevance. And for us, it became clear that to really build the Farfetch brand and to build the engagement with the customer in an even more powerful way, we could benefit from having that direct access from brands directly to consumers through our platform. It's a bit like the Netflix strategy. It's creating original content that then differentiates the platform, which then lowers the customer acquisition and retention costs. Obviously, it's a small part of our business, and it will remain a small part of our business, but an important one. And to give you an idea, the biggest traffic day we ever had on Farfetch was an Off-White Nike collaboration, a drop where we had 800 million visits in a couple of hours. That's 10% of the world population, without $1 single spent in marketing. And consistently, we've seen these type of collaborations and this type of cultural relevance really bring a lot of engagement and app installs and new customers to the platform. So that's the background in terms of our acquisition of NGG, which is a platform that creates brands from zero. Off-White was created from zero to multi-100 million. Palm Angels was created from zero to well over 100 million. And Reebok comes in that context. So for us, the opportunity when we saw that Adidas had sold Reebok to ABG, that is a brand that is, a heritage brand. It's actually older than Nike and older than Adidas. It has been a brand that was responsible for many of the innovations in terms of sneakers. Those old enough to remember the pumps, they were pretty cool. So the archive is phenomenal. It's a really fantastic archive, and they haven't done much with it. So we really believe that bringing back these iconic styles, and pair them with cultural relevant collaborators can really build a very exciting business for sneakerheads and for our customer who's a fashion enthusiast. And so that's the whole plan. We then also took the European license so that license is global. So we will, from 2024, we will start launching these archive products, these collaborations, which we think will be, and it's a good moment because I think it's a moment where in the sneaker market, people are looking for, new hits and new concepts that, really change the game there. And that's a global license that we have with ABG and it will be in 2024. What we launched already in 2023 is the European license for the full spectrum of the brands, including the more mainstream. So that was around historically a $500 million brand under Adidas in Europe. And that's what we launched just a few weeks ago. And we did that because we believe that controlling the distribution in Reebok's a British brand, so controlling it in the car market, it's important to then build the global hype for the brand. So we're excited with the team we've built. The CEO that is running Reebok was 25 years at Nike. He was part of the car founding team of the Nike Energy program with all these collaborations. We got to know him via the Off-White collaboration, convinced him to move from Portland to Milan, and he's built a team around him of ex-Nike, ex-Adidas, some ex-Reebok from the team that was in that business already. So we think we have the right talent, the right team, and we're excited. We've just launched it, but that's where it sits. And the impact this year is between $250 million and $350 million, and it will be seen both in the brand platform, which is where we book the wholesale sales of Reebok, and in the digital platform, where we book the digital sales of Reebok. So from that 250 to 350, you'll see the impact on those two parts of the reported segments.
Got it. Okay. And you've talked about there's some investments you need to make to get this business really going. You've talked about $170 million. Perhaps maybe not all of that is for Reebok. I think certainly the majority. But how is that kind of transition going? Just building out all the infrastructure that you need to there.
It's going really well. We've built a team. The warehouses, we never own warehouses. It's 3PLs, but obviously we have a certain cost in terms of setting them up and paying for the ramp up of the logistics. Sales and marketing team, design team. So, everything that you would expect to run a business at that scale. We've done it in a very disciplined way and conscious of the current environment that we live in. Profitability and cash generation are our absolute priority this year. And in fact, we have reduced our like-for-like fixed cost base around 10% year on year. So from $850 million of SG&A spend last year, we're going to cut $85 million thanks to the headcount reductions that we've already made last year. So this is not new stuff. This is things that we've implemented last year that will have a full effect in 2023. And then the costs that we've built to run these significant, sizable businesses are being built up in a gradual and very disciplined way, but it's progressing well.
Okay, great. Two other new partnerships. Hoping you could just talk about what you're doing there, perhaps timing and impact. Ferragamo recently launched, and then also Bergdorf within Neiman Marcus in the back half of the year.
Yeah, we're on track, on schedule, on budget with all of those. We have a very strong track record of enterprise-level large launches. With Harrods, we delivered absolutely to the day. Actually, Michael Ward, the CEO, we have a testimonial that we use all the time because he was very kind to us, and he said, first time I delivered a project of this size to the day that we said we were going to launch it, and absolutely on budget. We did the same with Tmall when they invested in Farfetch and we launched the Tmall store. We actually did it ahead of time, and many others. So we have this consistent track record. Again, this year with Ferragamo, we launched it already. Reebok launched. Bergdorf Goodman is absolutely on track for second half of this year. And then we have the Richemont transaction, which is going through regulatory approval. We expect to have the regulatory approval until the end of this year. And after that, we will be allowed to accelerate the build of those websites and launch Cartier.com, which will be the first and the largest maison within the Richemont group, as well as Net-a-Porter, which is the largest within the YNAP group, in the first half of 2024, and then all the other maisons after that.
Okay, let's stick with Richemont and YNAP. I guess here's what can you do just from a kind of not just pre-planning, but perhaps system-wise, operationally. What can you do kind of while you're in this interim approval period to get ready? And then I guess second, how do you think about tackling more on the hard luxury and jewelry TAM, part of the business? I think it's 25% or so of global luxury overall, but this gives you a much stronger kind of position in that business.
Absolutely. I think, hard luxury, we have the customer, certainly. Our record sales have been watches, actually. We sold a couple of watches for around $2.5 million. One was Tiffany Patek Philippe, the other was a Richard Mille watch. I mean, we really have the customer that is willing to buy. We also fine jewelry. We sold fine jewelry sets for $1 million, etc. But we don't have the supply. And the reason why we don't have the supply is that traditionally the fine jewelry and watch brands have been even slower than the fashion brands to embrace online. I think Richemont is an absolute breakthrough for us because our competitors, so these brands, they don't sell wholesale. Cartier, for example, Van Cleef & Arpels, they just don't do wholesale. And because they don't do wholesale, they're not present in the competition. Because again, our competition is all department stores or retailers. And that gives us an incredible opportunity to really become the destination for hard luxury online. And so we have a plan, a strategic plan in 2024 to really push that category, which is 25% of the industry, but it's only around 2% of our supply. So it's a supply constraint. We absolutely have the customer, we have the demand and the desire to buy these brands. And with this deal, I think we unlock the largest player in the category, and that is already leading to very interesting conversations with other watch and hard luxury players in the industry. You have Richemont. Oh, interesting. What are you doing with them? And what are you building here? So we're building this hard luxury hub, and we think it's going to be great news for the customer and a potential expansion avenue for us.
Okay. Maybe just shifting to profitability, it's clear you've been driving some strong efficiencies in your demand generation spending over the past few quarters. Can you just talk about how you've gained leverage there? I guess, is it sustainable in a stronger macro environment, or how will you lean in perhaps again as the environment improves?
I think we plan to continue to be disciplined in terms of the demand generation spend. So we think around 7 to 7.5% of GMV is the right way to think of it, which is down year on year materially. Now, I think in terms of profitability and cash generation is our number one priority. With my team, I did this exercise, 10 battles we can't lose, and number one is profit and cash. And for us, it's very important. It's not something Farfetch hasn't achieved before. So we were adjusted EBITDA profitable, not a lot, but we were in 2021, and we were operational cash flow positive in 2020. So this is a business that two things need to happen. We have to stabilize 1P, and the 3P marketplace business needs to grow. It doesn't need to grow a lot, but needs to grow. And that cash generation, because we have an advantageous working capital cycle with the 3P, more than offsets the interest expense and the capex. And you saw that in 2020. And in 2021, we delivered adjusted EBITDA profitability. So this is not, some companies have never turned an EBITDA profitable or cash, and they're now trying to position themselves in that way. We've done that before. We have to go back to those days. We're doing it with much more discipline than what we had in the past. I think we're going to look back in 2022. I said this to you today. It just came up to my head. I think we're going to look back in 2022 and say it was the best thing that happened to us, because I think it was the permission and the necessity to be disciplined with the cost base and really squeeze more efficiency out of the business. And I think the combination of that allows us to look at 2023 with strong confidence that we're going to deliver in those targets. In terms of cash, we believe that we're going to end the year with more cash or the same cash than what we started. That's the target. We have several levers to achieve that. One is obviously the normalization of our inventory. But the other, we have things like at the moment we have a build-up of $220 million of money owed to us by governments in the European Union. I won't bother the audience with VAT tax refunds in the European Union. It's a fascinating topic. But to cut a long story short, we're owed tax refunds from these 27 governments. We could take them off balance sheet on 95 cents on the dollar or whatnot. They're very high quality receivables. But we have started to receive money from these authorities. After Brexit, there was a very long delay. This is now starting to become more regular. And we believe that a lot of that receivable is going to be converted into cash, or at least a material portion of it this year. And then into 2024, we'll get on a more decent cycle, let's call it this way. So in terms of being paid from these tax refunds. So there are elements of the balance sheet which either are going to be normalized or are going to be converted in cash. That, together with the positive working capital dynamics as we go back to growth, we believe that second objective is in sight, and we're very focused on it.
Okay, real super quick word association, whatever comes to mind. Demand generation.
Save money.
Macro.
Uncontrollable.
U.S.
Great opportunity.
Palm Angels.
Maverick brand.
Why not Richemont?
Future potential.
China.
Golden opportunity. I'm using two words. I'm cheating.
Well, no more,
I'm cheating.
E-concessions.
Farfetch invention.
Private client.
Our car customer.
EBITDA profit and free cash flow.
Inside.
And luxury online.
Farfetch.
All right, great. Thank you.
Thank you very much.